Welcome to the Three Questions Webcast series. I'm Wayne Baxter, Senior Executive Manager with One Capital Management. At One Capital Management, we develop and implement strategies for our clients which strive to grow, protect, and ultimately distribute their wealth. We do that by offering investment wealth management services. Thank you for taking time to check us out. Clients are often referred to as cross-border clients. Now, why would that be? Well, it's because they're either U.S. or Canadian residents who invest in U.S. and or Canadian dollar denominated securities like stocks, bonds, and ETFs. Our process for advising our clients includes an in-depth discovery and diagnostic analysis of their wealth management goals and objectives. And as I've often stated, wealth management is multifaceted. There are several areas beyond investment and retirement planning that need to be discussed and considered. At One Capital Management, we call that process advanced planning. And under the advanced planning umbrella, we include an in-depth risk management review, or if you prefer, a review of non-investment risks that a family will likely face as time goes by. An example, almost everyone who works to earn an income and depends on that income they earn to pay off for their living and their lifestyle expenses, they face a serious financial risk should they no longer be able to work because of an injury or illness. Now, what's interesting is that the majority of North Americans don't realize this risk until a disability interrupts their stream of income. That's when it's too late by then. On this edition of the Three Questions Webcast, we're going to speak to a life and health insurance general agent who specializes in the placement of life insurance, long-term care, and disability income insurance for more than 50 insurance carriers across the United States marketplace. Now, if you find today's episode interesting and helpful, be sure to subscribe to our channel so you don't miss an episode. On this episode of the webcast, we're going to address the three questions you should ask before purchasing long-term disability insurance, also known as disability income insurance. Joining me once again on this edition of the Three Questions Webcast is Scott Thurman. Scott is the principal and a life insurance general agent with Thousand Oaks, California-based TNT Premier Insurance Solutions. Welcome again to the Three Questions Webcast, Scott. Great seeing you.
Thank you, Wayne. Thank you for having me on again. Appreciate it.
We've definitely covered a lot of topics here since we've been doing these webcasts. You've been a frequent guest. Not only have you been a valuable resource for this webcast, but you've also been a very valuable resource for me and my clients, especially when it comes to assisting me with, sourcing out right insurance strategies, the underwriting process, and ultimately placing life and health insurance related products with my clients. I really appreciate it. And I'm really happy to have you back again.
Thank you. Good to be here.
Yeah, for sure. Now, we've recorded a few of these now. And, if you've missed any of our previous webcasts that Scott and I have done, we've covered term insurance, permanent life insurance. We've talked in depth. We had a two-part series on long-term care insurance. If you've missed any of those, I would encourage you to visit our Three Questions Webcast YouTube channel and check them all out. They're great information. And again, I think we should just maybe take a couple seconds here, Scott, just to talk about the complexity of having to understand and evaluate and determine, what should I have? What should I be using? And I know for you as your career path of being able to look at this, maybe you just share some thoughts on the complexity of understanding and identifying the appropriate uses for all these types of products at the consumer level.
Yeah, so as a life and health agent, there are many, many pieces that play a part in what type of insurance is needed for someone. And everybody's situation is different, so that plays into it. Whether they're young or old, what stage of life are they trying to sell a company? Are they recently divorced? Are they recently married? There's just tons of pieces that play a part with the individual. And then you combine that with the pieces of the different types of products that are available out there, along with the different life insurance and long-term care carriers and DI carriers. They all have little different way of doing business. They have different underwriting. Their products can be a little bit better in one area, but not as good in another. And you sort of have to analyze, from my perspective and from a professional's perspective, as a trusted advisor, you have to be able to analyze what these carriers are doing and how they best fit into a particular person's situation. And you have to find the product and the company and the underwriting and everything else that fits best. And it's not easy, but after years of doing it, it gets easier. And that's typically what I do.
I think one of the really important things that you mentioned before that there are like over 50 carriers that you kind of keep an eye on. And, you might think that, well, I've got my term insurance policy with, I'm not going to name any names here today, but just,
Right.
brand X insurance company. You can't automatically assume that just because I got a great term insurance policy from that particular carrier, that they are the go-to for permanent insurance, for long-term care insurance, or as we're going to talk about today, long-term disability or DI insurance. You really have to do your due diligence and determine which is the best solution for carrier, because you're going to have to probably do some mixing and matching.
Absolutely. It's true.
It's 100%. So that's where you come in, Scott. You've been a great resource. We've discussed term insurance, we've discussed permanent life insurance, we've talked about long-term care insurance. It's now time to address the 3 questions you should ask before purchasing long-term disability insurance, aka disability income insurance. So we're going to get right to the questions. And the first obvious question, and we've done this, I think, pretty much on every webcast now that I think of it.
Right.
Why do I need DI insurance, or why do I need long-term disability insurance?
Yeah, that's a great question to start with. And I'm going to start out. I don't have all of the statistics memorized, but I do have a lot of statistics in front of me today. And that really tells the story, because the statistics don't lie. And you know how much I love life insurance and think everybody should have it. But the average American in a year is 5 times more likely to become disabled than to die.
Mm-hmm.
But they're more prepared financially for death. So more individuals have life insurance than disability income insurance. 67% of American workers have no long-term disability insurance, even though there's a good possibility that they could go on disability. Over 375 Americans become totally disabled each year.
375,000?
Yeah, did I say million?
No, it's okay.
375,000. Okay.
No, you did. No, I'm not correcting you. I'm just emphasizing the fact that that's a significant amount of the population.
It's a huge number. And there are about 8 million adults that have a disability that prevents them from working. I mean, those numbers are staggering. And the chances of someone from age 25 to retirement age having an event that causes them to have disability is very good. I mean, there's a very good chance. And when someone goes on disability, I remember reading the statistics from a 40 to a 55-year-old, if they go on disability, the average is right around 3 years. So it's a long-term disability event. I mean, 3 years is a good amount of time. One other statistic that just blew me away: 46% of all foreclosures on conventional mortgages are caused by a disability.
That's a statistic that I actually know that you share that one. When I was back working in Canada, I think that same statistic was applicable back then. That same number, that sounds very close to 45-46% of foreclosures.
Yeah, I mean, that alone is a reason to get disability income insurance.
I'm going to throw one at you, Scott. There was one year, this is like, good Lord, I can't believe it, like 20 years ago. There was this one year where every new client I met, I asked them, what is your most valuable financial asset? I would say for every, I don't know, can't remember the exact number. We'll say there was 100 people I met. This would be like 2002, 2003. I would ask them, what is your most valuable financial asset? And I would say 95% of them would tell me, oh, my house, for sure, my house. And we would do an analysis, and I can only think of this one client, and I remember him really well. I know his son still follows me on social media too. He was the only client I had where he was right. His real estate was his most valuable financial asset. Without question, the bulk of the people I met with, their most valuable financial asset was their ability to make money.
Yeah. Yeah.
So there you go.
And so that's why you need a disability income insurance, because if you do something and lose that ability, then most people don't have the reserve.
Lose your ability to make you lose your ability to make money. It's going to be a tough road to hoe going forward.
Yeah,
all right.
And illness is the main reason, believe it or not. It's not accidents. Illness is the main reason that people go on disability, some type of disease.
Interesting.
Yeah.
I think most people think of it as being disabled because they get hurt, right?
Right.
I remember one of my least favorite scenarios I experienced. Again, I had this one client, this is back in Canada again. I had shown them the importance of having DI. For whatever reason, they did not take my advice, did not get it. And I don't know how far from then until this happened, but we'll say months later, they contacted me. They had been working on the roof of their house and they fell off.
Yeah.
Now that's just bad karma, bad mojo there. So I've always remembered that, act or be acted upon is what kind of a favorite saying of mine. Right. So, okay. So I think we've got an idea about why LTD or DI insurance is so important. Let's go to the second question. This is an often question we get here. Why do I need to purchase DI insurance if my employer's benefit program already provides coverage? I mean, I'm getting DI through my work. Why am I going to need anything else?
Yeah, you really need to check and see with your employer what type of insurance it is. It might be short-term disability. In most cases, it is. That'll cover you for less than six months or less. And depending on the amount of coverage also, it might not replace the amount of money that you need to replace. So if the average disability is 3 years for somebody 40 to 55, and I just took that swath because that was a figure that popped out to me. If you're going to be on disability for 2.5 more years, you've got to get that covered. And unless you've been in the workforce 10 years, you can't go on permanent disability, Social Security disability. In addition, that amount's not going to be as much as you would hope. If you get a long-term disability DI plan in place, it is going to replace the lion's share of what your income was. Most carriers are 60 to 65%. The reason it's 60 to 65% is because you are not taxed on those dollars that come to you. So it's tax-free. If they give you much more than that, then you will be encouraged not to go back to work because you'll be making more than you were while you were working.
You brought up a really good point about the tax angle on this. So most, I can't say all, because that wouldn't be true, but most DI, group DI policies. So in other words, policies offered through a plan, a plan administrator through a group insurance to an employer. And this applies to in Canada as well here in the US. A lot of times the premiums are paid by the employer.
Right.
So if you're getting, let's just use 60% because it's an easy round number. Let's say your annual income is $100,000 a year and your DI policy covers 60%. If the employer is actually paying your premiums and then you have to make a claim, then that 60% that you get, that $60,000 becomes your new taxation base. That part becomes tax. So you're not, in fact, getting the net. The net is going to be, your what you pay tax on after the $60,000 is what you're going to get. So you're not. So that's really something you need to understand.
Right.
Who is paying these premiums?
Because when your company is paying those premiums, it's a benefit to you, and they say, okay, we'll pay the premiums for the short-term disability. Then they're expensing that more than likely. I mean, they're going to do
think
that.
Maybe
and since they're expensing it, the government's going to get their taxes one way or the other.
So if you have the option, sometimes it's not a bad idea to pay the premiums out of your pocket for your, depending on the scenario. Or, the other solution is just to have your own individual policy that's not in any way, shape, or form tied to a DI policy through an employer, which of course comes with its own potential issues of, changing. You don't control the contract if it's a group policy.
Right. And is it portable? When you leave your company, it's probably not portable in most situations, which means you get laid off or you leave your company, takes you a month or two to find another position, you fall off that ladder or that roof like you're talking about, then you're disabled. What are you going to do?
Well, again, it's so important to understand how your policy, again, we talked, remember we did a webcast on term insurance and talking about how not all term insurance is the same. Boy, oh boy, is it ever true for DI or for long-term disability insurance. They're not all the same. So the most important thing to understand, and it kind of moves into our third question, is you should ask, the question is, how is my DI insurance policy structured? And there's lots to think about here. There's a thing called own occupation, any occupation. There are elimination periods. You have to deal with what the payout schedule is going to be. I'd really like for you, Scott, just to help the folks listening in today or watching today, just sort of give some context to this in terms of the importance of how a DI policy is structured. And when you're looking at the type of strategy you're employing, it's not one size fits all.
Right. There are a few different factors going into your policy when you apply for it, and when what I call an illustration is created. One of the things is you're going to have a payout schedule, and that we already touched on a little bit. It's typically going to be 60 to 65% of what you're currently gross making. So you would turn in that figure in order to get a illustration or a quote back. And let's say you're making $10,000 a month, then it would probably come back that it would pay out at 60 or 6,000 or 6,500 per month if you went on claim, if something were to happen to you. There's also what's called an elimination period, and that typically is for many policies around 90 days. And basically what that says is it will not pay out until day 90, and then it starts paying. Most policies have that in there. They all also have it in policies such as long-term care policies. A lot of times what happens is you might go into the hospital for an illness. You can say, hey, I think I might be on claim. They'll start the clock then. You may be in the hospital for a week, 2, 3 weeks. You're going to have a time period where you're going to be, you're not going to be able to use that until it kicks in by 90 days. That's just part of the program. And then the third part is, depending on what type of a occupation that you have, that is going to tell you how much you're going to have to pay. Not only the amount of insurance you need, but also the type of occupation, whether it be a doctor or a white collar worker or somebody that's maybe out on a
there's different rating, there's different qualifications based on your occupation.
Exactly. And they will charge more for somebody that maybe is a general contractor that's out on the job, that's around a lot of men working, men and women building a building or something like that, where it might be a little bit more dangerous than somebody sitting behind a desk. And so they have different ratings for those, and they'll rate those differently.
Well, you know what? We've covered a lot, Scott. We've covered long-term care. We've covered the need for permanent insurance, the need for term insurance. We've just now done a webcast on the importance of DI or long-term disability. We are going to have to think of a new topic, which I'm sure between the two of us, we can come up with something. But I really want to thank you. You've been awesome, great resource. And I'll ask again, I'm sure folks listening in today are probably going to want to pick your brain and maybe a little talk to you. And really, what is the best way for them to reach you? How do they reach and get a hold of Scott?
Yeah, my direct phone line is 805-208-6587. And they can also email me at scott@tntpremierinsurance.com.
And Scott, thanks a lot. I really appreciate you joining us. Scott Thurman is the principal and a life insurance general agent with Thousand Oaks, California-based TNT Premier Insurance Solutions. I look forward to bringing you the 3 Questions Webcast series, and I hope you find them educational and informative. Please consider liking this video and subscribing to our YouTube channel. And to receive a notification of when our latest webcast has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you and see you soon.